Hey everyone, Couch Investor back to another video for today. So, healthcare stocks. In 2023, that sector did not perform quite well. That's actually an understatement. But in 2024, many analysts, many fund managers expect that sector to outperform the market. And so, I've picked out 4 stocks, 4 companies, 4 players in the healthcare industry, which I think should be on your watch list. Maybe for some of you, those are even in your portfolio right now. Some of them are a bit riskier than others, but I think the price is pretty attractive. Now I'll start with a big one that is pretty popular out there, and that's Humana. Now Humana is the 5th largest player in the healthcare plans industry. By the way, in November, there was an announcement that Cigna was seeking to acquire Humana. The result, the stock tanked. Now in Q3 2023, the results there, Humana posted a double beat with adjusted EPS of $7.78, surpassing the consensus of 61 cents, and revenue also increased year over year by 15.9%, hitting $26.42 billion. Now that metric also beat analyst estimates by $840 million. And if we look at the company's valuation right now, forward PE, EV to EBITDA, price to sales, price to free cash flow, don't be so excited seeing price to sales at 0.5 times in the next 12 months. This company, well, these types of companies usually trade in this range. Now, if we do look at forward PE, yes, we can see that it is cheaper than its 5-year mean, currently sitting at 14.4 times compared to 18.9 times. Market cap of that company is now at $54 billion, paying a 0.81% dividend yield. Now, you're not only getting value from that dividend, you're also getting value from share buybacks. In the last 10 years, shares outstanding have been reduced by 21%, and free cash flow per share has been increasing as well. And then if we look at the EPS estimates, the 5-year growth rates here, that sits at 12.23%. Now, there are currently 21 analysts covering this company. The average price target sits at $578, representing 31.76% upside. If we look at the dividend growth, the annualized growth in the last 10 years was 12.5%. If you want to look even closer, 3 years, 12.39%. So quite an exceptional growth story here when it comes to dividend payout. They've also been increasing their dividend payout for the last 14 years. Now, what are analysts expecting for the next 2 fiscal years? Well, sales growth for fiscal year 2024 of 8.38%, and then a reacceleration in fiscal year 2025 of 9.15%. If we look at EPS for fiscal year 2024, we'll see 11.15% year-over-year growth, and then in fiscal year 2025, 17.29% year-over-year growth. So despite being a pretty popular name, a pretty big player in the healthcare industry as well, you're getting some growth here because also of the weakness in the stock. But the company bottom line, as you see, is increasing faster than the top line, pays a nice dividend, increases that dividend as well each and every year. Plus, it does some buybacks. So I do think this stock is worthy of being on your watch list. Now, before moving into stock number 2, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, stock number 2 is a company called Centene. Now, Centene specializes in managed care services, offering health insurance plans to government-sponsored programs such as Medicaid, Medicare, and the health insurance marketplace. Now, if we go back to the Q3 earnings, they beat it top and bottom line with non-GAAP EPS at $2, surpassing expectations by 46 cents. The company's revenue reached $38.04 billion, exceeding analyst estimates by $1.91 billion, marking a 6% year-over-year increase. They've also already issued guidance for 2024, so 2024 adjusted diluted earnings per share of greater than $6.70. The board also authorized a $4 billion increase to stock repurchase program, and they reaffirmed the 2023 adjusted diluted earnings per share guidance of at least 6.60 cents. With regards to revenue, the company expects to generate revenues between $142.5 billion to $145.5 billion. Now, if we go and look at the current valuation here we're seeing that compared to its 5-year mean, It's a bit more expensive than Humana, for example, with PE being extremely close to its 5-year mean, 12.4 times compared to 12.6 times. And here as well, you can see price to sales, a number, if you look at tech companies, a number that you rarely see, 0.3 times. Price to free cash flow, that's in the last 12 months, 7.7 times compared to 31.9 times. So on that metric, it is much, much cheaper. But the other two here, PE, EV to EBITDA, it's either the same as the 5-year mean or a bit more expensive. Now, in the last 3 to 4 years or so, the company has been buying back their own shares. Shares outstanding have decreased 8.71% in the past. Through acquisitions, the shares outstanding have increased. But overall, free cash flow per share has increased quite nicely over the years. If we look here at EPS estimates, the 5-year growth rates sits at 9%. Currently, there are 18 analysts that are covering this company. The average price target sits at $87.22, representing 10.68% upside. And if we look at what the analysts are expecting for the next coming fiscal years, for fiscal year 2024, sales to decrease by 4.58% to $143.45 billion, which is basically the midpoint to what the guidance was. And EPS to increase 0.9% to $6.75. And then for fiscal year 2025, a reacceleration there. Sales growth 4.43% year over year and EPS growth 12.12% year over year. Now up next, company number 3 is a bit more, let's say, on the riskier side. It's also a much smaller company, and that's Halozyme Therapeutics. This name was given to me during a live stream from one of my viewers. I looked into it and it looks pretty interesting. So what do? Well, Halozyme helps other medicine companies deliver their drugs better. Think of them as the delivery guys for medicine. This is, of course, a very, very basic explanation. They have a special enzyme that breaks down a natural barrier under the skin, making it easier for other drugs to get to where they need to go. This makes treatments basically faster, easier, and more effective. Now, more specifically, the company's products are based on the patented recombinant human enzyme with a very, very specific name, which will pop up on the screen right now. And this is basically, let's call it the code for it. I'm not going to pronounce it because I can't. Then with regards to the latest Q3 earnings report, they reported non-GAAP EPS of 75 cents, beating the estimates by 4 cents, and revenue increased 3.4% year over year, which is basically in line, reaching $216 million. Now diving a bit deeper into the financials, so there are a couple of segments with regards to revenue. We've got royalties, product sales, and collaboration revenue. Now collaboration revenue is the one that took a hit quite hard. It's down 69%. But royalties, this is something that drives free cash flow, of course. That's up 15% year over year. And net product sales is up 41% year over year. If we look at net income, that's up 33% year over year. And GAAP diluted earnings per share up 39% year over year. With regards to guidance, well, they updated that, so total revenue stays the same. That will grow at 26.5% year over year, the midpoint. Royalty revenue is expected to grow at 24.5% year over year, the midpoint. Then EBITDA is a small increase here from the previous expectations. That will grow 37 to 41% year over year. And diluted earnings per share, a small increase here as well. It should increase between 22 to 27% year over year. Now that's not all. This company announced a $250 million accelerated share repurchase, completing the current $750 million share repurchase, $150 million in 2021, $200 million in 2022, and $400 million in 2023, with $150 million completed in Q1. So in the past 5 years, they have repurchased approximately $1.3 billion worth of shares. Now, will they be able to repurchase more and more shares in the future? Well, of course, it depends on the company's execution, and especially when it comes to the product launches. According to them, by 2025, Halozyme projects 9 products will be contributing royalty revenue, almost double from 5 at the beginning of 2023. And this is their, let's say, big next step, enhance a royalty growth story. Of course, this is the opportunity, but this might also be the risk if it does not work out. Now, looking at valuation here, like I said, much smaller than the other two companies that we've covered. Market cap $4.55 billion, and here valuation much cheaper than its 5-year mean. Forward PE 9.4 times compared to 29.1 times, EV to EBITDA 8.6 times, price to sales 4.3 times, and price to free cash flow in the last 12 months 12.9 times compared to 32 times. If we look at share outstanding, yes, in the last 10 years, shares are up a bit, but in the last 3 years or so, shares have been reduced by 8.4%, as we've discussed just before. Free cash flow per share in the last couple of years have turned positive, have increased quite significantly as well. Of course, it depends on the product launches and on the royalty generated. There are currently 11 analysts covering this company. The average price target sits at $50.3, representing 46% upside. And if we look at what the analysts are expecting for the next 2 fiscal years, incredible growth top and bottom line. So for fiscal year 2024, sales growth of 31% year over year, EPS growth 34.6% year over year. Jumping into fiscal year 2025, sales growth of 7.63% year over year, and EPS growth 17.86% year over year. Definitely here again, bottom line outgrowing the top line. So unlike the first two, this company is growing much faster. It's a smaller company, has a bit more risk to it, but the upside is much higher. Now going into company number 4, a bit of the same story, smaller company, higher risk, higher reward as well, and that's AbCellera, ticker symbol ABCL. Now, by the way, AbCellera, Peter Thiel is on their board. Now, what do? Well, AbCellera is a biotech company based on AI-powered platforms dedicated to discovering and analyzing target-specific antibodies. The company emphasizes partnerships to expedite the drug delivery process and potentially reduce the clinical trials for at least a year using its 3 high-tech platform. The company basically focuses on being a general research accelerator. Going into it a bit more, so AbCellera's proprietary platforms use AI to search and decode natural immune systems to identify antibodies. The main strategy is to develop drugs to prevent and treat diseases, mainly starting from partner-initiated programs. Talking about those partners, currently they have 10 molecules in clinic, and as you can see, that has been growing each and every year. The amount of partnered programs have increased over the years as well. And if you look at the names of the partners, these aren't small players, these are one of the biggest players in the industry. Now, if you go and look at their financials, you will see that it fluctuates sometimes, especially after the pandemic. Now, if we go and look at Arnie's Substack, link is down in the description. Incredible guy, incredible write-ups. You might know him from the Palantir coverages. So he said here, basically, AbCellera proved the quality of their tech during COVID-19. In only 3 months, they developed the first antibody. The huge company, which now obviously is known because of the weight loss drug, the partner of the program sold the antibody and generated around $1 billion in revenue for AbCellera in royalties. Oh, and by the way, this company is a company worth $1.5 billion and it has $813 million in cash equivalents, and marketable securities. So you're not really paying that much of a premium. Yes, some quarters, some years, it will burn that cash. Some others, it will make. Now going back to Arnie's write-up, unlocking a $400 billion market. So AbCellera solves the biggest issues in the drug development. 1, time, cost, failure. With time, 9 to 12 years from initiation to drug approval. Cost around $3 billion per drug development. Failure, around 90% of candidates fail to reach approval. This creates a strong disincentive to invest in drug development. And this is, of course, where AbCellera comes in. And so looking at some valuation metrics, of course, right now we don't really have that much to play with or to look at, shall I say. There was a time where the company was profitable. Like I said, pandemic boosted the company's financials. But if we look at the average analyst price target, currently there are 9 analysts covering this company. The average price sits at $16.57, representing 207.45% upside. Of course, as you can see, the trend here for the average price target has been going down for quite a while. And then last thing here, what are the analysts expecting for the next 2 fiscal years? As expected, tremendous growth, top line, bottom line, still unprofitable. Top line fiscal year 2024, 58% year-over-year growth after a big down year in 2023. As you can see, 92% decrease. And then going into fiscal year 2025, sales should increase by about 28% year over year, while EPS still stays negative. While this might look like an extremely risky biotech company, I don't think it is. It is a much more stable company that has already quite a proven track record. Yes, it's still early stages, but like I said, the risk here is higher than the other companies, but the reward is much, much higher. Whether you like that or not, that's up to you. That's why there are 4 companies in this video. You can choose from those 4, or maybe you have others in the healthcare sector. Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.